I wanted to bring a new thought process in your mind that how asset allocation has to be done and why it's necessary. So that's what today's session is going to be. So let's look at how what has been history telling us. So largely, this is a small graph that I've drawn. Don't worry about those unclear lines. Reason is because I've intentionally stretched it across, so that's why it's unclear. There are three charts out there. If you first one, what you see is the red line, which is a pink line or red line that you see, is how equity market has been. The green one represents the bond market movements, and the or yellowish one, which is the gold. Typically, if somebody had invested, 100 rupees in any of the asset class, I've normalized all of them to 100 rupees. How it would have done over a period of 5 years. So basically, from 2000 to 2005, if you were to look at it, bond markets actually flourished, and it almost became 200 rupees over 5 year period. It just got doubled in 5 year period. Whereas equity market managed to languish and then managed to come closer to that. Almost to equity markets by 2005 after 10 years. If you look at that interim pocket, we notice that gold and debt actually did better than equities over the period. And if I move forward and take it up to 2008, so if you see, there's a dramatic change that is brought in equities. Equities is languished for a long period of time. For 5 years of underperformance, got compensated in the next 3 years, and that almost became 600 rupees. So basically, it became 6 times in that particular by 2008, in 8 years, and bond completely flattened up completely. When bond got flattened up, you saw one more notice, that is that gold actually was doing better than bond markets. So moving forward, if I take it a little longer, and if I see how it has happened by the end of 2008 2000 period, we saw the subprime crisis which happened, and the majority of the market started falling. So equity market crashed. Whatever additional returns that we saw in the last 3-4 years in equity markets, that completely fell down, and we saw equity giving lesser return than that of bonds and then that of gold. So if you see this here, almost, if not very much visible though, you would find equities giving lower returns over an equity and a debt market. So that basically gold became the number one return. Forward 2012, gold became a supernormal hit, and gold started almost, it became 8 times by 2011 end, and we saw equities underperforming gold, and that has done constantly enough, and it is moving in its own fashion. Uh, of course, this debt is only, I've taken the 10-year index, so that's why this is not the fund. Fund returns could be little higher than that, but majoritively, if you look at it from the index perspective, gold actually became a number one asset class. Now, does it mean gold is always the best and equities is not going to be doing well, or debt will always remain down? So moving forward, again by 2012 end also, gold was continuing to flourish. Equity was slowly picking up. Forward again by 2017-18, we see equity corrected, equity went up, gold started correcting a bit. Forward to current situation, if you see what is happening, that's the current situation is that gold actually started delivering almost equivalent return to that of equities, thanks to the fall that happened in equity markets, and that continued to be on a nominal basis, on a constant basis. Now, the thought process here is that there is no single asset class which is actually done well at all point in time. There are pockets in between where each of the asset classes been having its own cycles. Okay, of course, the real estate data is not available, so I have not got real estate in here. But if we were to benchmark real estate also, it would not be very, very different. Real estate also would have had its own pockets. Now, majority of the time, what happens is there is a misconception in Indian investors saying that equity markets are always high return yielding instruments, and gold never falls, gold never corrects, gold never will, if you invest and if you leave it there, it will always give a consistent return. So I have taken the same 2005 to 2019 data on a year-on-year calendar data. So if you look at it, how three asset classes, Nifty versus the bond index, as well the gold, which is the three benchmarks which I showed you on the graph, the same data more or less represented in numbers here. I want to highlight few things across to you. So if you look at how Nifty has been doing, so if you will find that there were 7 years out of the 15 years cycle that I've taken were phenomenally big years. So if you look at this 2007 or 2005 to 2007, money just multiplied overnight, literally. Right? We had 1 year 37%, 40%, and 59% kind of thing. And then a 53% fall happened in the subprime, which is like basically took away 1.5 years of gains. And then eventually the year after that, it compensated for all the returns that it fell in 2008. By 2009, it almost compensated not only the fall, but also it gave a much higher return than that of whatever the fall that was. So overall, in 7 years, had phenomenally great returns out of the 15 years. So basically 50% chances of we making high return possibility. When we look at gold, we see that gold had 6 calendar years, which actually had phenomenal good years. Then debt, there's been I've pointed out few good years because these are for a debt perspective, 10-11% has a decently good return for those pockets. So but again, if I have to look at even from this perspective of 2015, right, 8.82 at those prevailing interest rates, even the bond rate exactly is better, but I'm not considering all of those. So 4 years out of 15 years was a great years for debt. So motamoti, what happened is that we had 50% of the time where equity did well, 50% or 40% of the time we had gold did doing well, another 20% of the time bond doing well. So now look at the negative years. So negative years, equity had 3 years out of 15 years as bad years, which actually one of the year is like marginally down. If I were to add another year of 2018, let's make it 4 years out of 15 years were not so great years. For gold also, this is an important factor, guys, because gold also corrected, and not the small corrections, it almost corrected 17.5% almost, sorry, 18% almost in 2013, which people, memories are short, people forget, people tend to forget that gold will also correct kind of things. And then again in 2015 we saw a correction, and you notice one more thing. Whenever there's a sharp spike of returns that gold has given, you find that the next year is already normally normalized, or it goes in for a very flat return or a negative return. So we don't know what's going to happen in the part. But let's predominantly put it at 2 years out of 15 years were bad years for gold. Now this, if were to happen, you notice something very, very nice and important is that there are pockets when gold is done well, where probably equity is not done well. This is a pocket, you see this, as well as this. I don't know if my cursor is visible to you, but just look at 2010 and 2011, when gold did well and equity markets didn't do well. In 2013, gold actually did pathetically bad, but you had compensating effect which came from equities and debt, which almost gave about 7.5%. The year after that, 2014, also happened to be the similar kind of a year, where you saw equities delivering 35% and debt giving you a phenomenal 11% and gold giving you just about 2%. So why am I highlighting this across to you? Is to give you a small thought process on how do we optimize returns for our customers. Now, can we go back and pinpoint and match those dates and say that, okay, this is the year that gold will do well, this is the year equity will do well, this is the year when bond will do well? Nobody can do that. I mean, if someone is saying he's lying, or he has to be probably God and he says that I can predict the future. Right. So, well, when we have to optimize those returns, if I made a simple mathematics, I've taken equity at 11% yielding instrument. We'll assume that equity will just give us the basic return of inflation plus growth rate of the country. Considering the growth rate of India slowing down because of all those XYZ factors, I'm not getting into that zone, then a lower inflationary scenario, we should expect about 11%. I'm putting number there. And gold will give us the inflation return, which is obviously it is what is it's expected to give, which will be about 7%. And debt, because of lower interest rate regime, will give us about 6%. A combined factor of this, if we had invested in different asset class, typically what I've done is, because there are three different asset classes, I've taken general, the mindset is either they invest in equities or they don't invest in equities. But investors who don't invest in equities normally have a tendency of buying gold and doing fixed deposit or some kind of a debt instrument. So I've divided that part of it equally between gold and debt, and equities I've given the other side of it, so which is a corollary of it. If you were to look at it, if there is an investor who is putting 100% entirely into an equity market, he will get about 11% return, which is what we expect out of equity market. But for a guy who is at the bottom end, who is saying, I will be risk averse, I will not invest into equities, I will only invest into gold and debt, then he will end up getting about 6.5%, which will be lesser than the inflation kind of a number. Now, both are bad situations. Why both are bad is because from the returns perspective, equity allocation is great, and but the pure non-investing in equity, avoiding equities or staying away from market will end up giving you very low returns, and this will happen to bank FD customers also today. If you look at it, last week we saw one activity that came up, which is typically when we saw ICICI Bank also reducing rates, for which was preceded by SBI, who have all reduced interest rates of their FD rates to almost sub of 5%, on some of them even 4.5%. If that were to be followed, so that will give us nothing better than 4.5, 5%. In this scenario, if somebody is investing purely into debt and staying invested there, is going to lose out. And then 100% equity investor have only one other problem, which is this problem is the volatility on pure equity is going to be higher. Like I showed you on the historical graph, how much of equity market swinging that happened. So that volatility will also impact the customer. So now what's the best optimization level? How do we optimize customers for that? What's the solution for that? Is typically to find a middle path for the customer. Now, with this particular ideology, if you were to tell the customer that if you were to pick up 60% or 70% into equity, if your slightly appetite is higher, or even if nothing, if you want to take up only 50% equities and allocate the rest to between gold and your fixed income product, your returns could range between 8 to 9%, or it could touch a double digit number, which is a far better number, which is almost double the number of not participating in equity. So you need an equity at all point in time, but it need not be fully exposed to equity. So you need to have an allocation between all three of this. So looking forward, if somebody were to mix this particular portfolio at a basic rate of having 70% into equities and 30% divided between bond and gold, how would the portfolio asset mix look like? So I'm not saying that just because you are making an asset mix, it will not give you negative return. So that's why I wanted to showcase this to you as well. So this is in reverse chronological order. So last year, because now, of course, this is actually come back because if you were to look at how the market has been actually coming back, but on the portfolio side, it has not come back. So I'm more or less saying that your asset mix would have given you negative returns in the 2000 and 2001 kind of a scenario. Whereas there are pockets when when your bonds didn't do well. If you look at 2004, or when there are pockets in 2008 when equity market fell 51%, but overall portfolio got protected because of exposure to bond and gold, so which made it 33%. And the same thing which repeated in 2011, back again when there were pockets where equities didn't do well, which is 2018. If you look at it, equity market just gave 5% return, whereas your bond and gold actually made up by giving 8% each. So which means customer was almost getting equivalent to his FD return of 6%. And in good times, like 2019, where we saw equity giving 13% and your bonds also delivering 10% and gold also giving about 20, 21%, customer ended up getting a double digit 15% return. So this is, of course, I'm not saying this is an ideal mix. You can pick and choose whichever is the best mix for the customer, depending on his risk appetite and how much. But the thought process which I wanted to bring to you in this particular masterclass is that don't avoid any asset class. Have a classification of everything. Putting money entirely into a bank account or putting entirely into an FD and leaving it there is also a little bit criminalization on optimization of return, because you're ending up getting a very lower return, and putting very aggressively into equity at all point in time also does not justify a great portfolio return. Optimization would happen when we balance it out for customers. So whenever you are doing portfolio allocation for customer, keep in mind that how much. Of course, there's one more thought I need to also give it to you. A lot of times we forget that customers would have FDs. So add those FDs to bonds. That's fine. It's a risk shielding instrument. And gold in physical form, we need to discount it by 25%. Why? Because there are making charges, wastage, and all that. So which is typically 25% knocked off from the jewelry, if it is jewelry form. If it is biscuits and gold in pure form or demat or ETF format, you can take it at whatever the market price which is, and consider the total allocation which is there. And based on that, arrive at a number which could be a good mix for the customer, which will give the customer a good level of protection and good level of upside and a lower downside. The drawdown, what we call it as the whatever the fall that were to happen if equity market were to fall, or even if gold were to fall, even if were to bond market were to fall. There is no guarantee which markets will fall. Gold also, like I showed you, gold also could correct, or bonds also could correct. When that correction happens in any of the asset class, the other asset class is going to protect the total portfolio of the customer. So this is what we need to keep in mind. And this asset allocation, if we can bring it into the customer's portfolio, we would be doing a better justice for customer's portfolio. So this is what I wanted to give you. I ran pretty fast because the format is 15 minutes. I've covered it well within the time. I'll open the question floor for you guys to ask questions, whatever you have.
Hi, Maitre, this side.
Hi, Maitre.
Yeah, in this slide, actually, I could not get what is the asset allocation that you have considered in this?
In this, I have put 70 and 15, 15. 70 into stocks and 15 into bonds and gold. So basically, just a example sake, I've taken actual index returns, and that I have taken it as if 70% was invested into equities and 15 was into bonds and gold. So that is how it is. In the
uniformly across from 2000 to 2019, right? Across
yes,
all the years.
correct. And in this particular chart, I tried to showcase if 100 to 0 and 50-50, this is 100 to 0 here. So which is a reverse order and a mix of this particular thing with the return expectation of 1611. Here, the return expectation is, I have not put the return expectation in this next. I've taken the actual data here. That's why these numbers are little different from each other. Yeah, Leo, this is not an official PPT. I'll share it across to you, not a problem, because there's nothing to hide out here. I'll share it to you. Maitra, hope I answered your question.
Yeah, thank you.
Any other questions? Anything else? I'm sorry about this name, which is showing as Mera Business, because this is of tomorrow's event, Sunday's event. We've already configured most of the things, so I didn't want to change anything out there because it's a bigger event there rather than masterclass, because masterclass is between the family itself. For the event, we have almost got 2,000 plus participants. So a lot of pressure and a lot of working going on. So I didn't want to do any kind of edit out there. So it remains, my name is not visible, so that's okay. Amit, yes, you can keep one as a benchmark. This, if you want to keep this as a benchmark as 70 and 15, 15, you can keep this as a good classic benchmark. That's why I showed you this as a good example. You can keep this as a standard thumb rule. Use this also. Or if the client is looking at a little higher return and says that, I want a slightly better optimization of returns, then you can mix and match this kind of combination. Yeah, so this is, today convincing it for equity, Manisha, thanks for asking. Convincing for equity is very, very simple and easy because I have noticed with a lot of you guys is that investors themselves have started knocking at your doors and they've started asking, my FD is now maturing, my returns are coming down. The new FD is at 4%, 5%. Uh, there are people who are senior citizens who have been looking at it because now their challenge has been that their monthly income is at stake because of lower interest rate. They would have calculated their monthly incomes based at 8%, 9% FD rates. Now it has come fallen flat down. So in that kind of a time, what you should do is you tell them that let them not take full exposure to equities, but little exposure, like 30% or 40% of equity exposure is still a nice exposure because if you avoid equity completely, your return potential, which is upside of almost 10, 11%, that no other asset class can give, right? Only asset class which can give us the economic return, the complete return of how the market or how the country is behaving is can only happen from equities. So tell them that have a decent amount of little allocation so that instead of getting 4.5%, it can get better by 1-2%. Of course, that will have a little volatility, but that's why I wanted to showcase to you. Doesn't mean that FDs will not have volatility, right? We are seeing it right now. FDs have interest rates have fallen. Bond market returns can be volatile. Gold is return can go negative. That's exactly what I wanted to showcase to you. So tell them that in every asset class, including real estate, many people believe that real estate will not correct. If you ask me in Bangalore, last 2 years, real estate has been completely down. People, I've been speaking to a lot of real estate firm owners, and they have been telling me that they're not able to sell properties across. Customers who had bought are selling it at a lower price than even the builders prices. Why? Because they need money and there is no buyers out there. So real estate also corrects every asset class in the country. We are born on this earth. Volatility is the name of the game, and we cannot avoid the volatility. So volatility will be there in every asset class. So tell them that equity will also be having an asset class which will also be volatile, but that volatility is getting reduced to you by not having 100% exposure to equity, but having a lesser exposure. That's the language you need to tell them, Manisha. Any other questions? You can type it in or you can unmute yourself.
Actually, I just wanted to share one thing which I'm experiencing due to this falling fixed deposit rates.
Hmm.
So I've been to PSUs. When I've gone to PSUs, they themselves are cannibalizing their FDs. They themselves are pitching corporate bonds and something which gives a return of over 8%.
True,
So
true.
they themselves are not very keen that people continue with FDs.
Yeah, that's because your credit offtake has been pretty bad. Not just because of no demand. Unfortunately, that's why I don't like the banks. I'm probably going to make a video around it. Why I hate the banks. Okay, so they take away our deposits and then in turn misuse them. We have seen that. I don't know how many of you saw this. I didn't get a chance to see this, but I know what the case was because I've read this part of the book as well. Harshad Mehta scam. And there's one more movie coming up on the same story. But of course, what I got to know from a couple of friends is that the truth has been little altered and made it look like, but okay, that's a series, so they have to make it that way. But how many of you see there it was public money which was misused by the bank? We see Nirav Modi, we see Malia, we see those kind of big cases where it's our money which was deployed and given to wrong hands, and they've all run away with that money, right? And it happens today also. So much of NPA is there. And when situation is there, when genuine people are asking for credit and they're saying, "Was give me loan," these same banks are saying, "No, I will not lend you." Okay, and on the other side, they're publishing a data that credit offtake is bad. So naturally, when they're not able to deploy this money, what they're raising at 4% from an FD, even at 6-7%. So naturally, they're saying, "I don't want any more FDs. I don't want a commitment from that." So this has been a fact. Thanks for highlighting this, Mati. That's true. They themselves have been pushing people to get into mutual funds and other investments rather than getting into FDs. It's become a burden. FD has become a burden on banks. Fair. I don't think any more questions are there around today. Should we wind up? Okay. Thank you very much, guys. Have a lovely weekend and a lovely evening. See you around. Keep learning, growing, keep making money. Okay. Anything that you have, please reach out to us. Leo, sorry. I'll share the PPT to you guys. Of course, the data can be yours.
Hello.
Yeah, Manish. Yeah, Manisha.
Sir, in the last session, you were told that you will be getting that recording from Zoom the other day and the video will be posted. But the same, I guess, it has not been done.
The last session video is already there on YouTube, I thought. This is a private channel, what you see on YouTube. I'll ask your PST team to forward you the link.
I will
Yeah.
share. I'll share. No problem.
Yeah.
Yeah.
Okay. Thank you, sir.
Thank you.
Thank you.
Yeah.
See you guys. Have a lovely weekend. And don't miss Shivkera's session. It's a request. It's
Yes.
going to be a lovely session because I've heard him a couple of times. Very, very inspirational. Some of it could be look repetitional if it is in the case also, but it's an amazing session that he does, and he's truly inspiring. So I get inspired a lot of times. So don't miss that. Sunday, keep yourself free for just 4 hours between 11 and 1. See you around, guys.
Thank you.